All right, let's get into our briefing for Sunday evening, March 22nd. We are heading into a really fragile week, and it feels like everything is hanging on one thing, the price of energy. So how does that actually work? How does one variable have so much influence? Let's break down the system.
So you might be asking yourself, what does an oil well, maybe thousands of miles away, have to do with my assets, with my portfolio? It might seem like a huge leap, right? But believe me, right now there is a direct, incredibly powerful chain reaction that links those two things. And you guessed it, it all starts with oil. And this is the perfect way to visualize it. It's basically a domino effect, a transmission chain. First, you get the move in energy prices. That immediately gets people thinking about inflation, so inflation expectations move. That in turn forces bond yields to react. Then, those changing yields have a big impact on the US dollar. And a stronger or weaker dollar, well, that tightens or loosens financial conditions for the entire globe. And that's the final domino that hits risk assets, stocks and the like. The really critical takeaway here is that a pretty small shock at the very beginning of this chain can cause huge waves by the end.
Okay, let's start at the beginning with that first domino, oil. This is the inflation trigger. And let me be super clear about this. Right now, it is the single most important macro driver out there. Everybody is watching it.
So here's where we stand. Brent crude, that's the global benchmark, it's hovering around 111, maybe 112 bucks a barrel. WTI, the US one, is a bit cheaper, sitting around 98 to 100. But the really interesting thing here isn't just the price, it's the gap between them. That's a spread of what, $11 to $13? That's pretty wide, and it's telling us something important. It's a signal that this isn't just a US issue. This is a global stress, probably tied to supply fears for all that oil that has to travel on ships.
And yeah, the reason for all this stress is no big mystery. It's geopolitics. Specifically, everyone is on edge about the Strait of Hormuz. This is one of the most critical choke points on the planet for oil. If anything goes wrong there, even a small disruption, the impact on global supply is immediate and it is huge.
This quote really nails it. In the current macro regime, oil is not simply another commodity. It is the starting point of the entire transmission chain. And that's exactly it. In this environment, oil isn't just another input, it's the spark. It's the thing that lights the fuse for that whole chain reaction we talked about, and that's why we have to watch it so closely.
Okay, so we have the initial shock from oil, but how does that shock actually get bigger? And how does it spread? Well, that brings us to the next parts of the chain, yields and the dollar. You can think of these as the amplifiers.
So in the bond market, there are a couple of key patterns we're looking out for. The first one is called a bear steepening. All that means is that long-term yields, think the 10-year Treasury, are rising faster than the short-term ones. And when you see that, it's a classic sign that the market is starting to price in higher inflation risk for the future.
And then you've got the opposite, which is called a bear flattening. This time, the short-term yields are the ones rising faster. This signals a totally different kind of concern. It's less about inflation itself and more about the fear that central banks might have to hike rates so aggressively that they choke off economic growth later on.
But here's where we have to dig a little deeper. It's not enough to just see yields rising. The real question is, why are they rising? Is it because real yields are going up? Or is it because inflation expectations are going up? If it's real yields, that tells you the market is giving up hope on rate cuts and financial conditions are tightening. Simple as that. But if it's because of inflation expectations, that's a lot more worrying. That could be a signal of a real inflation shock on the horizon, maybe even the dreaded stagflation. Figuring out which of these two is in the driver's seat is absolutely crucial.
And then, of course, there's the US dollar. As yields go up, the dollar tends to get stronger. And a strong dollar, well, it can act like a global wrecking ball. It just sucks liquidity out of the system, puts a ton of pressure on emerging markets, and just generally makes investors less willing to take on risk. It basically takes all that pressure building in the bond market and broadcasts it to the rest of the world.
Okay, so it's the weekend. The stock market is closed. How on earth do we get a sense of how people are feeling? Well, we look at the markets that are open 24/7, and that means crypto and gold. Think of them as giving us a real-time vitals check on the health of the entire system. A lot of macro traders are basically using Bitcoin as a live, minute-by-minute sentiment gauge, and they kind of think about it in these three zones. If Bitcoin is holding up above 69,000, okay, things feel pretty stable. Risk appetite is holding on. If it's chopping around between 67 and 69,000, that's more of a neutral, let's wait and see kind of vibe. But if it breaks below 67,000, that's the red flag. That's a signal that sentiment is really starting to sour and you might have some serious liquidity stress building up under the surface. And where are we right now? Well, Bitcoin is sitting around 69,500. So based on the framework we just laid out, that tells us risk sentiment is cautious, for sure. But it is holding steady. It's not a green light, but it's not a flashing red one either as we head into the new week.
Now let's talk about gold, because it's in a really interesting spot. It's literally being pulled in two different directions at once. On one side, you have all this geopolitical fear that should be pushing gold prices up. But on the other side, you have those rising real yields and that strong dollar we talked about, and those are powerful forces pushing gold down. So gold actually becomes this amazing diagnostic tool. Here's the test. If geopolitical tensions get even worse, but gold doesn't rally, that tells you everything you need to know. It means the bond market and the dollar are the ones calling all the shots right now.
All right, so this brings us to the end of the line, the final domino. What does all of this mean for the stock market? Well, we know U.S. equities finished last week already feeling the pressure, and futures are looking a little soft. So let's game out a few potential scenarios for the week ahead.
It really boils down to three main possibilities. Scenario 1, the calm one. If oil just kind of stabilizes here, then yields will probably hold steady too, and we might actually get a nice little relief bounce in stocks. Scenario 2, the slow burn. If oil keeps creeping higher, then those inflation fears are just going to intensify, and that's going to put more and more pressure on risk assets. And then there's Scenario 3, the ugly one. If we get a serious geopolitical escalation over the weekend, then you could see energy prices spike, and in that case, you're probably looking at a pretty nasty gap-down open for stocks on Monday.
Okay, that was a lot to cover, so how can you keep track of all these moving parts without going crazy? I'm going to give you a simple dashboard. Just 4 key numbers you need to watch this week. Think of them as your lines in the sand.
Here they are. First, for oil, keep an eye on Brent crude. If it breaks and stays above $115, that's a big deal. The market will have to reprice for higher inflation. For bonds, watch the 10-year Treasury yield. A move above 4.75% is a key danger zone. For the dollar index, or DXY. If that pushes above 105.5, that means financial conditions are getting seriously tight. And finally, for our real-time sentiment gauge, Bitcoin. A drop below 67,000 would be that major warning shot we talked about.
So that leaves us with one final thought to chew on. You know, when you look at the markets day to day, the price action can seem totally chaotic, almost random. But is it really? Or is it just following the cold, hard logic of the system we just laid out? Understanding that system, that's going to be the real key to navigating whatever this week throws at us.